All right, let's get right into it. We're going to be talking about the keys to some of the most valuable and, let's be honest, most complex refundable tax credits out there. You know, for tax pros like us, mastering these rules, well, that's what separates a decent preparer from a truly trusted advisor. Just look at that number. For a family, say, with a couple of kids, the amount of money we're talking about from these credits can easily top $7,000. Yeah, I'm talking about the big ones. The Earned Income Tax Credit, Child Tax Credit. This isn't just a little extra cash, you know? For your clients, this is life-changing money. But here's the big question, right? With that kind of money on the line, how certain are you that your client is actually eligible? Because you can bet the IRS is looking at these credits very closely. And that burden of proof, that due diligence, it falls squarely on your shoulders. Making a mistake here isn't just about fixing a number, it's about your professional integrity. Okay, so here's the cool part. The thing that makes this whole thing manageable. You might think you need a whole ring of different keys for all these credits, but you don't. For a lot of the big ones, we're talking EITC, the Child Tax Credit, even the American Opportunity Tax Credit. There's really just one master key. If you can understand this one core concept, you've basically unlocked the main door for all of them. So, what is this master key? It's the legal definition of a qualifying child. And look, I know that sounds like tax jargon, but it's not. It is the most important definition you need to know. It's a super precise 4-part test, and it acts like the main gatekeeper for literally thousands of dollars in tax benefits. You get this right, and everything else just kind of falls into place. So let's build this key together. It has 4 parts. Think of them as the teeth of the key. And here's the deal. A child has to meet every single one of these tests. It's an all or nothing situation. There's no partial credit. So let's break down exactly what these 4 tests are. First up, we have the relationship test. And this one seems simple, right? But be careful. The IRS has a very specific, very strict definition of who counts. It's not about who your client considers family. It's all about who the tax code says is family. So who makes the cut? Well, obviously it's your client's son, daughter, stepchild, or an eligible foster child. It also includes a brother, sister, or step-sibling. But here's the little detail that catches so many people off guard. It also includes any descendant of those people. So we're talking about a grandchild, a niece, or a nephew. That's a huge extension of the rule, and it's absolutely critical to remember. All right, on to the second tooth of our key, the age test. And this one is a little more complex than just, being under 18. There are actually 3 different ways a child can pass this test. Okay, first, the child has to be younger than the taxpayer. That's a must. Then they have to meet one of these 3 conditions. Number 1, they're under age 19 at the end of the year. Simple enough. Number 2, they're under 24 at the end of the year, and they were a full-time student for at least 5 months. Or, number 3 is the exception. They can be any age if they are permanently and totally disabled. Moving on to our third test, the residency test. This one sounds pretty straightforward. It's all about where the child lived. But trust me, this simple-sounding rule has some major implications. The rule is actually super simple on its face. The child has to have lived with your client in the US for more than half the year. That's the magic phrase. Now, of course, there are exceptions for temporary stuff, like if they're away at school, on vacation, or getting medical care. That time still counts as living at home. But that more than half the year rule, that's the hard line you cannot cross. And here we are, the final test, the joint return test. This one's all about preventing a specific kind of double dipping, and it has to do with whether the child themselves filed a tax return. So here's the rule. The child cannot have filed a joint tax return for the year, period. However, and this is a big however, there's a key exception. If the child and their spouse filed a joint return only to get a refund of taxes that were withheld, then they can still pass the test. It's a small detail, but it's something you absolutely have to ask about during your client interview. So you've gone through all 4 tests. Great. But what happens when a child meets all those tests for more than one person? Think about a kid living with their mom and their grandma. Who gets to claim them? This is where the IRS tiebreaker rules come in. And just so we're clear, these aren't suggestions. It's not a negotiation. It's a strict, step-by-step process that decides who wins the claim. And the hierarchy is super clear. Step 1, if only one of the people is the child's parent, the parent wins. Simple as that. Step 2, what if both people are the parents? Then it goes to the parent the child lived with for more time during the year. And finally, step 3, if the time is exactly the same or if neither person is a parent, then the tiebreaker goes to the person with the higher adjusted gross income, the higher AGI. Okay, so we forged our master key, but I want you to remember something really important. This key, the qualifying child definition, it gets you in the front door, but each specific credit, each log, can have its own extra little requirements you need to know about. Let's look at a couple of quick examples. For the Earned Income Tax Credit, or EITC, a qualifying child can only be claimed by one person. That's it. For the Child Tax Credit, the child has to be under age 17. So you see, the qualifying child definition is the foundation, but it's not the whole story. You always have to double check the specific rules for the credit you're actually claiming. So really getting these rules down, internalizing the master key, the tiebreakers, all those little credit-specific details, that's the whole foundation. It's what lets you file with confidence. It lets you serve your clients properly and protect both them and yourself from some really costly mistakes. Because here's the bottom line. Due diligence isn't just a good idea. It's not optional. It is a professional requirement. It's all about having the discipline to ask the right questions, to get proof, and to document everything. That's what takes you from just being a tax preparer to being a trusted professional advisor. So let's wrap this up. I want to leave you with one final thought. Knowing all these rules, that's half the battle, for sure. But when the IRS comes knocking, just knowing the rules isn't enough of a defense. The real question is, do you have the records to prove it? Do you have the school reports, the medical records, the documents you need to back up your claim? Answering yes to that is what truly defines a professional.